Good morning. It's Jeffrey Christian of CPM Group. It's about 10 minutes after 11 in the morning on the 23rd of June, Friday, here in New York. I'm going to talk about the market outlook, what's happened, and what CPM Group continues to expect to happen. So we'll be looking at gold and silver prices, which have come down sharply over the last couple of days. And, CPM Group had issued trade recommendations last Thursday saying that, yes, we still hold by the idea that prices would weaken in the period June, July, August. And we thought that they would be weakening. We had a 1920 objective on gold, which was hit yesterday, or actually went below it to 1919 this morning. Gold's trading around 1929 as we speak. Silver, platinum, palladium all went below our objectives. I'll get back to that in a second, but first I want to make a correction. In our most recent video on Tuesday, the 20th of June, I was talking about the anti-hedging campaign that broke out among gold institutional investors and some private investors in the late 1990s. And I mentioned Graham Birch, who was working at Mercury Asset Management as a fund manager, portfolio manager at the time, and he took the lead in the anti-hedging witch hunt. But when I mentioned Graham Birch, I actually used the name Peter Birch, and I apologize that. Peter Birch is a coin dealer in California, and he is a great purveyor of great things. I was looking at yesterday's email from him where he suggested that the banking crisis, whichever banking crisis he was referring to, was actually orchestrated by evil people, seeking to take over the banking industry. He said that China appeared to be teetering on the brink of something, and the debt ceiling suspension was leading to new disasters. That's Peter Birch. I was talking about Graham Birch. Now, while I'm on the subject of hedging a little bit, one of the things that doesn't stand up to logical scrutiny that people who are against gold mining companies say in defense of their anti-hedging posture is that hedging should be left to the shareholders. Shareholders should hedge their investments, but mining companies should hedge their company's operations. And they can do that in a way that protects them from downside moves in prices, has a very predefined, minimalized credit issues and risks, and gives them typically 90 to 95% of the upside of prices. You can do that with a compound option. I think CPM Group has had its clients using this hedging strategy since options were allowed in the mid-1980s. It works very well, generates a tremendous amount of money. It's like playing poker, and you can lose $1 per hand, but your winnings in any given hand are unlimited. So you know that you could possibly lose $1, but you also know that you could win incalculable amounts by betting. That ability to limit your losses gives you a incentive to take greater risks in your betting in a poker game. In operating a mining company, if you can say, I can guarantee myself a minimum cash flow from my production, but I also am preserving all of the blue sky, that means that I am being responsible in the financial management of my company. And that responsibility lies at the company level, not the shareholder level. Shareholder level, shareholders should take care of themselves. Company level, the management should take care of the company. And if you can guarantee yourself a cash flow, a minimum cash flow, unless you have operating problems, but preserve most of the upside for your company and its shareholders, then you're being more responsible than if you don't. But that's hedging. I wanted to talk about the markets. So precious metals have come down as we had been expecting. Prices have gotten down to, as I said, for gold, 1919 this morning. We had a very short-term, trade recommendation with a target of 1920 that we issued last week. We've issued a new one this week with a lower price target for the next week or two, closer to 1900. And then if you are a client of ours and you get our precious metals advisory, you would know that we have been saying for some time that we thought that the price could drop as low as 1850 over the course of the June, July, August, September period. We actually are thinking that there could be more downside because the economic environment and financial markets' perceptions of the economic environment have strengthened. And in our most recent trade recommendation for our clients, where we have 1 month and 3 months ranges that we talk about, we actually say, it could fall below 1850, could get as low as 1800. Right now, we're holding to that 1850 more broadly. But remember, last summer, the price fell, and it fell sharply. You can see it here. It had been around $2,000 in the first 4 months of the year, and then it got down to $1,624 by last November. We don't expect it to go below $1,700. We actually don't expect it to go below $1,800. Could it? Yes. That's the nature of markets. So our expectation is that it's going to be weak for the next few months, strengthen at the end of the year. We base that on several factors. One is that you are seeing financial markets coming to understand that while there are many problems in the world economy, political systems, and financial markets, they're not as critical as perhaps they thought they were 2-3 months ago, March, April. So there is a backing away from the uncertainty in the stock market, the bond market. There is an understanding that when you look at the two groups of people, central banks and governments probably have a lot more wisdom and power on their side than the people who are waving their arms and saying that the gold price, that the world's going to collapse. We'll get back to the world collapsing or not in a little bit later at the end of this video. So you're finding investment demand weak. You're finding it weak in China, India, North America, and Europe, backing off. Additionally, central banks, there are some central banks that have been buying, fewer central banks than a year ago. And there are a couple central banks, Kazakhstan and Turkey, which have actually been selling gold in the first few months of this year because they needed to raise foreign exchange, foreign currencies to pay for imports. So you have seen in the first 4 months about a 1.9 million ounce net increase in central bank holdings over the January through April, which is much lower than a lot of people thought. So you're seeing on the fundamental basis that you're seeing some increase in mine production. Mining companies are doing better. And in addition to that, you're seeing an economic environment where investors have said, okay, interest rates are high, they're rising, but it's probably okay. It's probably not going to throw us into a recession, at least for the next several months. There probably is a recession down the road, but it's more likely to be in 2024, 2025 than it is in 2023. So in the meantime, I could redeploy assets into stocks and corporate bonds and other financial assets. So you've seen investors backing away from gold, partly because of the macroeconomic environment. And that's probably going to continue for the next period of time. Very similar situation in silver. We've seen the silver price come back down. It is about $22.30 or so as I speak. It has gotten below $22, and it does have the scope for further weakness. Again, we don't see it falling down to $17, $18 the way it did last year, but we do see the scope for summer weakness as both seasonality kicks in and reduces fabrication demand and investment demand, And as investors sort of reposition their portfolios, predicated on the view that while there are problems in the world, those problems are not hanging over their heads right away. I will point out, a couple of weeks ago, we pointed out that at the end of May, you had various pundits on the internet saying that silver would be $3,000 by the end of June and gold would be $30,000. They've got a week to go. It's less than a week now, 6 days before the end of June. And the opposite's happened. Yeah. And I think one of the things that you're seeing is on the broader financial markets, people are coming to understand the power and capacity of central banks to manage the economic situation and manage their finances in a way to help preserve economic growth to some extent for some period of time in the face of major economic issues that lie beyond the control of monetary policy and monetary policymakers. Again, and I've said this repeatedly, and I guess I have to always say it, if you look at overall economic conditions, including inflation, but also economic growth or contraction, fiscal policy by governments is more important than monetary policy in determining overall economic trends. All due respect to Milton Friedman and the monetarists. And real economic trends in the real economy, supply issues and demand issues by corporations and consumers also are very important. And those factors all suggest that you will see a recession, but it's probably going to be delayed. We have two events coming up in July. On July 25th, CPM Group will be launching its 2023 Platinum Group Metals Yearbook, the third in our series. We do it every year in June or July. It's going to be July 25th this year. It'll be an online briefing, and you can pre-order the book or sign up for the online briefing at our website. It'll be 10 a.m. Eastern Daylight Time on Tuesday the 25th. Later in that week, I'm going to be speaking at a Rule Symposium on Natural Resource Investing in Boca Raton. And Rick Rule is doing a really remarkable job with Rule Investment Media and in positioning himself to bringing in really quality speakers. And he has some very good quality speakers at this conference. He also has some of those people who are arm wavers, who have been talking about $3,000 silver or $750 silver. And he's asked, Rule Investment Media has asked me to speak toward the end of this 4-day conference on the world is not ending, but the good news is you can still make money on gold and silver. Now, those of you who have watched these shows, these videos that we do are probably know exactly what I'm going to be saying, but it's reminiscent of what Doug Casey did in March of 2008. In March of 2008, Bear Stearns went bankrupt. It was engineered to merge into JP Morgan on a Sunday. The following Monday, the price of gold shot up over $1,000 for the first time. We advised our clients to stop buying at prices over $1,000 and to buy $900 puts with like an August strike price, with the expectation that the price would fall back within the next 4 months, 5 months. Actually, the price was like $904 or $907 within 4 days. By the end of that week, price was down almost to 900, and it fell below 900 by the beginning of April. So any investors who had bought those puts were able to sell them back at a very handsome profit. And they were still long gold. And Doug Casey asked me to speak. He was having a conference called Doug Casey's Crisis and Opportunities Investments. And the audience was basically self-made millionaires who were so concerned that, Democrats were socialists or communists and they were going to make us all use the same bathroom. And they were going to allow immigrants to come in and replace the white folk, and gay marriage was going to destroy their marriages. There's a great cartoon in the New Yorker about the time with two women in a bar and the one saying to the other one, "Gay marriage is not a danger to my marriage. It's the blonde he's sleeping with." Anyway, you had a lot of people, self-made millionaires, who were just frightened that someone was going to come and take away their money. And Doug's speakers were always universally arm-waving, panicking. This is the end. That was the theme of many of the talks. This is the end. And I said, the end of what? And most of them couldn't answer that question. One of them said, well, I think that the government's going to have to nationalize a couple banks. Well, they didn't really nationalize them, but they poured $1 trillion into them unnecessarily later in the year. And then we recovered. So I look at my presentation at Rick's Rules Symposium in Boca Raton a month from now, and I'm thinking back to the role I had in the market in 2008, and it's pretty much the same role that I have now. That'll be going on. You can go online and you can find Rick Rules Symposium on Natural Resource Investing, and you can sign up and you can come down and enjoy the rodeo. Maybe I'll see you there. Maybe I won't. In the meantime, take care of yourself. You can go to our website and read stuff, order stuff, pre-order our Platinum Yearbook. Take care of yourself. Take care of those around you. Take care of the world insofar as you can. And I'll talk to you next week.